Hi everyone, Professor Christensen here. Today we're going to take a look at recording inventory transactions for a retailer. So in our example, we're looking at Gabriella's Boutique, which is a retailer. So a retailer, remember, is a company that buys inventory from a wholesaler or from a manufacturer, and then it resells it to the ultimate customer. So in this case, we're looking at Gabriella's Boutiques. And you can see the transactions here that we're going to be recording. So basically, a retailer is going to be buying and selling, right? So in this example, we're only looking at the inventory transaction. So how they record the purchases of the inventory and the sales. All right, so let's take a look. So this is a new accessory item. They don't have any beginning inventory. The store uses Perpetual inventory, which means that they record all of the inventory purchases that come and go. And we're also going to add in that cash at the beginning is $10,000. Okay. All right, because we'll use that later when we come to our balance sheet. All right, so let's take a look at what happens. First thing is they buy 2,000 units at $350 each. The terms are 210 net 30. So when you see terms 210 net 30, what that's telling you is that this is on account, right? Because 210 net 30 means that the company gets a 2% discount if they can pay the bill within 10 days, which is a great deal. Otherwise, they have to pay the bill within 30 days. All right, so this is February 4th, and what's happening? We're buying inventory on account. Remember, inventory is an asset. It has a debit balance, so we're going to debit it for, let's just put in the calculation here. We're debiting it for 2,000 times $3.50 a unit, right? So that's going to be $7,000. All right, so we're debiting inventory because inventory is an asset. It's going up. We're going to be crediting accounts payable for the same amount because we owe that money. All right, I'm going to put all of these transactions here so we know what's happening in our inventory and also in our accounts payable. So let's put in purchase 24, and then we'll also put it down here. $7,000. Okay, so we have $7,000 in our inventory and we owe $7,000 on our accounts payable. Okay, so next thing is we pay shipping on the purchase of the $150 we pay shipping of $150 on the purchase. Now, what happens is these are two separate invoices. So the company that we bought the inventory from, we owe this $7,000 to, but then there's a freight company and we have to pay them separately. So this is an additional, remember that freight is an additional cost of inventory. So think of it, if you buy something online and you have to pay shipping costs on it, that's an additional cost of what you bought, right? If you bought something and it cost $10, but then you have to pay $3 shipping, well, it didn't cost you $10, it cost you $13, right? So here, this is an additional cost of inventory. So we're going to add it to our inventory account. And this is $150, and this is the same. And in this case, it says paid. So remember, when you see paid, that means that cash went out, right? Cash went down, so we're crediting cash. All right, so up here, we're going to put freight on 24, and that is $150. So that's an additional cost to our inventory. Next up, we found 100 defective units and we returned them on 2/6. So 100 defective units and returned them. What does that mean? So basically think of it this way. It's the opposite of what happened when you bought it, right? When we bought it, we debited inventory and credited accounts payable. So now we're going to do the opposite. We're going to debit accounts payable because why? Accounts payable is going down. And we're crediting inventory because inventory is also going down. We returned the inventory to the place where we bought it from. All right, so how much is this? Well, it's equal to $100 times the amount that we paid for it, which is $350, right? So we are returning $350 to the the seller that we bought it from. So now our inventory account is going to be reduced by $350. So let's call this 26 return. All right. And so we're up to date as of 2/6. Next up, on February 11th, we paid the seller the balance due, taking advantage of the discount. All right, so, oh, I forgot. Let me put this $350 here, because remember, this is a reduction of our payable. So this is return 2/6. All right, so we're going to pay the seller the balance due now. Now, how much is due? Well, we bought $7,000 worth of stuff, but we have to subtract the return. So we owe $6,650. All right, and we're paying that whole thing off. So it's 211. We're going to debit accounts payable for $6,650, which is the amount that we owe. Now, how much cash do we actually have to pay? Well, what we said before is that our terms are 210 net 30, and we paid within 10 days, so we get a 2% discount. So our credit to cash here is going to be 98% of the amount that we owe. Okay, our credit to cash is 98%, or we're taking out the 2%, right? So this is equal to 0.98 times the amount that we owe, $66.50. So our cash that we have to pay out is only $65.17. Now the 2%, and you could do the 2% first. The order of these doesn't matter. The 2% is a reduction in the cost of our inventory. Okay, reduction in the cost of our inventory. Why? It's a discount, right? We didn't pay as much as we thought. So this is going to be equal to 2%, so 0.02 times the $66.50. These two have to add up to $66.50, of course. All right. So over here we have 211 discount, and that is equal to $133. Okay. All right. So let's just take out our accounts payable. So we have payment, and the payment is equal to $66.50. So now our balance is 0. Okay. Because $66.50 minus $66.50. All right, let's stop here for a second and let's look at the net cost of our inventory. The net cost of our inventory is equal to the $7,000 plus the $150 minus the $350 and minus the $133. So the net cost of our inventory is $66.67. How many units is that? Well, remember we started with 2,000 and we returned 100. So the net cost of our inventory is $66.67, and our cost per unit, let's just put a little note here, unit, is equal to, I'm going to put it down here, which is a weird place, but it's okay. It's equal to $66.67 divided by 1,900 units. Let me fix that into a currency. So it's going to cost us, our inventory cost us per unit $3.51. All right, because we added a little for freight and then we took a little bit out for our discount. Okay, we need that later when we sell it, right? Because remember, if we sell a unit, we have to take $3.51 for each unit that we sell out of inventory. All right, which is what's happening next. So on February 12th, we sold 50 items this week for $6 each. All right, so let's say for $6 cash, right? So this way we know that we sold it for cash. All right, so we're going to debit cash, and we're going to debit cash for 50 items times $6 each. So we're getting cash of $300. What is this? This is revenue, right? Remember, when you deliver products or services to a customer, that's revenue. So we're going to call this sales revenue. Okay, now we have to make a second entry because perpetual inventory, remember, means every time you buy or sell inventory, you update your inventory account. So we're going to debit cost of goods sold, which is exactly what it sounds like. It's an expense that represents the cost of what you sold. So how many units did we sell? Well, this is equal to 50. We sold 50 units, and then remember we said each unit cost us $3.51. So we're debiting cost of goods sold, and we're going to credit inventory for the same amount. We're decreasing our inventory. Our inventory is going down. Okay, so we're going to credit inventory for 176. This is our 212 sale, and debit cost of goods sold. So anytime you're dealing with perpetual inventory and you have a sale, you have to make 2 journal entries like that. All right. Okay, so our last entry here, or almost last entry, February 15th. So what happens is Ramona's Closet, another local store, wanted some of these accessories for an event tomorrow. They don't have time to go out and buy it from the wholesalers, so Gabriella did them a favor and sold it to them for a small markup, right? So instead of $6, which is what they would normally sell it for, they're selling it for $4.50. Why are they doing that? Well, why not? Because you're still making $1 a unit, right? And also, maybe someday you're going to need something that Ramona's has. And so kind of the stores sometimes help each other out. All right, so $2.15. Now, what happened? We sold them 300 units for $4.50 each. Terms $2.10. Sorry, that should be $2.10. $2.10 net 30. Okay, $2.10 net 30. All right, so how is it different than this? In this case, the sale is on account. So we're going to debit accounts receivable. And we're going to debit accounts receivable for 300 units times $4.50 each. Okay? We sold Ramona 300 units at $4.50 each. So this is the selling price, right? And remember here, keep in mind, like this is the selling price, right? This here is the selling price. This is the cost. So first you have an entry at selling price, and then you have an entry at cost. So this is selling price, and this is cost. Okay? All right, so again, we have here sales revenue. And we're also going to have this same entry, debit cost of goods sold and credit inventory. And in this case, it's going to be equal to 300 units, because that's how many we sold, times, remember, each unit cost us $351. All right, so we recorded our sale to Ramona's. All right, let's keep track of our sales revenue over here. So the first thing we have is we have this $300 sale, and that was $212. And then we have the second sale, which is $13.50, and that's the $215 sale. Okay. And meanwhile, let's also take, we took the 176, let's take this 1053 out of inventory. This is our 215 sale. All right, so I think everything is up to date right now. All right, so now our final transaction, really our final transaction, is February 22nd. We get payment from Ramona. So Ramona sent us the money. Now, we sold, remember, this is what Ramona owes us. Ramona owes us $13.50, and we sold it to them $210 net 30, and they're paying it within 10 days. So how much is Ramona going to pay us in cash? They're going to pay us only 98% of what they owe us, because that's the deal, right? So they're going to pay us 0.98 times the amount they owe us. So we're going to get cash of $13.23. Now, what is this other account? This other account is called sales discounts, right? This represents the amount of discounts that we gave to our customers, and this is going to be the 2%. All right, so this is equal to 0.02 times the $13.50, and remember these two have to add up to $13.50. We're going to credit accounts receivable for the whole amount. This is the thing that gets students, hold on, so I can't type and talk at the same time. This is the thing that gives students trouble sometimes. Remember that the credit to accounts receivable is 100% of the accounts receivable. So even though the customer is only paying us $13.23, they paid off this whole balance that they owed us, right? So we have to credit accounts receivable. All right. So now let's talk about what of this goes on our financials. First, let's calculate our ending balance here. Let's say that it's let's say it's 228 and they're preparing financial statements. So our ending balance of our inventory is the 6667 minus this minus that. So we have 5439 in our inventory. And then we'll figure out how much we have left in cash. So we don't owe anything for accounts payable. We don't have any accounts receivable because the customer paid us, right? So we will have some cash on our balance sheet and we'll have some inventory. Let me make these bigger so we can do that again. Make those bigger. Okay. All right. So our cash is going to be equal to $10,000 because remember we said that was our beginning balance. Here's a credit to cash, so minus 150. Here's a credit to cash, minus 6517. Plus, here's a debit to cash, 300. Plus another debit to cash, 1323. All right, so we end up with cash of 4956. Our inventory is 5439. Let me move these down because I want to remind you where this goes on our balance sheet. This is under current assets on our balance sheet, okay? Current assets on your balance sheet. So we have cash and we have inventory. Now, what's going to go on our income statement? Well, there's a couple things that show up on our income statement. First thing is sales revenue, right? And our sales revenue, let's total it up here. It's equal to these two things. Add it up. We had two sales. We had one for 300 and we had one for 1350. So our sales revenue, our ending balance is equal to 1650. Now we're going to subtract our sales discounts. Sales discounts are what is called a contra revenue account. We only had $27 in sales discounts. So a contra revenue account goes against your revenue, right? Against your revenue. So this is called net sales, or it might be called net revenue. And that's equal to the $1650 minus the $27. Okay? All right. And then you subtract your cost of goods sold. All right. We don't have a calculation for cost of goods sold here, so let's add it up. So our cost of goods sold, remember we only had two sales, is equal to the 176 plus the 1053. So our cost of goods sold is 1229, and net sales minus cost of goods sold gives you what's called gross profit. So our gross profit is equal to the 1623 minus the 1229. Okay, so hopefully that will help you learn how to record some of these transactions with purchases and sales. They are tricky, especially when you get into like the discounts, the 210 net 30, and also the other thing that's a little tricky is keeping the buying and selling straight in your head. So I hope you find that helpful. If you enjoy these videos, please subscribe to my channel, and I'll see you next time.